Trading setups. Now, in deciding what kind of setups you want to be using throughout the day, the beginning of the day is very, very key. It is going to tell you whether you want to be considering more breakout type trades or whether you're going to be looking for more contained reversal type trades and a move back towards the middle of the range. Now, what you want to be considering is three main things at the beginning of the day. Firstly, you want to be thinking about where the market closed yesterday, one, in relation to value, and two, if it closed a long way from value, how far and what conditions were with that. You then want to be looking at the open, again, in or out of value and in relation to the close. And after that, the initial balance. This is going to give you an indication of what happens early on. Is the very quick initiative or is the market waiting for something? So let's move on, tackle the close first. Your close is very important in the sense of if we close out of value, and this is where I feel it's more important. If you get a close out of value, what this is saying to you is that late on in the day, participants have moved the market lower or higher and have then held those positions overnight. The next day, you do need to see a continuation of that type trade. Otherwise, those positions that have moved the market late on, particularly if done on low volume, are likely to reverse as they're not seeing that initiative move that they've created continue. These are usually medium time frame participants who move the market late on, and so they do need to see that continuation. So that's where it's very important where the close is late on. Another very important thing to note on closes, they are rarely ever left untraded. So the next day we will likely trade to the close. If the market doesn't, carry that forward. You'll hear me use that phrase a few times. Carry information forward. What this does is it tells you areas that the market could eventually come back to. So if you start seeing a market trend off rapidly higher and it's leaving closes untested below, it gives you an idea that at some point we are likely to see a bit of a reversal to it. It doesn't mean to try and play shorts every day looking for that move back to the close. It could be a long time. However, it does just give you information to carry forward that those closes have not been tested. Now, if you get a close in value, this is telling you that the market is very comfortable with those prices and is a little bit less indicative of trade the next day. You're going to need to wait for the open and what that does. That's going to give you a better clue. So moving on to the open. Again, in or out of value. If we get an open in value, likelihood is we're going to see slower trade to start with until you see a shift of value. If we see a shift of value away from yesterday's, then a more trend type move can begin. Until you start seeing that though, throughout the day, you're unlikely to be able to play those type of trades, and a reversals type strategy is going to be more beneficial. So that's the key with opening in value. And of course, also, if you open in value until it establishes a new value, you're likely to see slower, more rotational type trades. So again, perhaps a time to step back and consider trades for a little bit later on in the day until the market has actually decided what it wants to do. However, an open out of value gives you a slightly different perspective. You've got some questions to answer. Do we open out of value and continue the move? Do we open out of value and fail to go lower and accept back into value? Or do we test value and move away from it? So they're the three things you've got to be considering. And so how it does that is very important. If you get a move, say we open low, moved up to value, and then move back away, the market is showing you that it does want to go lower. It's not willing to accept value higher. It has tested it and it's found more sellers. So that's why it's showing you if we get an open lower out of value. And the same the other way, if we move lower and then can't continue, again, you're likely to get a move back towards value. Now, next up, the initial balance. This is the actual trade in that first hour. The important thing to note with the initial balance really is the size of the move. If you get a very large initial balance, this is showing that initiative has come in very early and established a range for the day. Generally, very large initial balances don't see too much further range extension because of the fact that positions have been built up very early and then value is going to establish around where the market has moved to very quickly on the day. A large initial balance is of course going to vary with your market. For example, a large Bund initial balance is somewhere around about 25 ticks. However, a large DAX initial balance is going to be closer to 70, 80 ticks. So be very aware of that, and you'll come to establish that depending upon what markets you're trading. So that's the key with the large balance. A smaller initial balance is showing you that the market is not yet decided, and so once you get a new shift of value, a new initiative come into the market, that can establish a trend. So a smaller initial balance is likely to lead more to a trend type day. So once you've got those things in your mind, you can then start considering what strategies you're actually going to use, and I'll have a little bit of a look at some of those examples in a moment. Right, you've got your trade setups and your ideas of trades that you want to be looking at throughout the day from the open, from those opening trades of the day. You then need some reference points, areas that you think the market can gravitate towards, areas that the market is likely to reject from. Now these come in the form of high volume, low volume areas, as well as your value areas themselves. So let's go and have a look at value areas first. The key thing with value area is the size of it and also its uniformity. If you have a very uniform and small value area, the market doesn't need to trade there again. Price has clearly been accepted. It's done a lot of time and a lot of volume in that area. It doesn't need to go there again. And so any moves into those smaller value areas are likely to move straight the way through them, providing very little in the way of support or resistance at each edge of the value area. So be aware of that. Small value areas generally get traded through. A larger value area is going to provide a little bit more support and resistance at the extremes, giving you more shorter term scalp type trades where you can get in, you can have a reasonably tight stop and look for a bit of a bounce from them. So that's the key thing with value areas. Also, if a value area has very little structure, and what I mean by this is it doesn't have that bell shape to it, that sort of that very curved value area. If it doesn't have that, then once again, it is likely that once you get into value, you could see congested trade where you get what is called a repair of the value area, where prices will balance out, and if you combine the 2 days, you would have generally a slightly more uniform looking value area. So always keep that in mind, the time that we could spend within value. So that's what's going to attract the market. That's what's going to slow it down as well. And that's what's important when you're in a trade. Is the market going to slow down in certain areas? Do you have to be a little bit mindful that you're going to have to wait for this trade to develop rather than expect it to just move and go straight away? Next up, high volume areas and prominent VPOCs. VPOC is the highest volume of the previous day. These are very important. If you have a very prominent VPOC on a day, so one price that is very clearly the highest volume price, that generally attracts the market back to it. So VPOCs are usually tested again. They may well become reactive, so you see a bounce from the VPOC and a move back away. Alternatively, you get the move straight through it, and like I was saying with the smaller value areas, they don't need to trade a great deal again because of the fact such volume has already traded there. So be very aware of that, but generally a very prominent VPOC, even if this is from a few days ago, so again, carry that information forward like a close that's not been traded. Prominent VPOCs generally attract prices back to them, so be very aware of that. Smaller VPOCs less so. This also works in terms of high volume nodes, HVNs, whereby you've seen over a period of days a large amount of volume traded at a certain price. Again, they attract prices back to them. Conversely to that, you have LVNs, low volume nodes, and also single prints. Single prints are where in the middle of the day you've seen an initiative move which has taken the market away from value, moved it somewhere, and then established value at a different area. These single prints are generally areas that you'll see the market reject from, particularly on the first time. And this is always key in trading. the first time is the time that matters. If you wait to see it test the single prints, test them again, and then have a go at a trade, likelihood is that it's then going to start to drift into the single prints. Once you get into single prints, the market again is likely to slow down, and because very little volume has traded there before, due to that being the initiation of a move, a lot of volume will then generally get filled out. The market will spend some time filling volume in at that area. So be very aware of that. The first time is the time that they're important. The first time is the time you're likely to see a rejection. This goes for a low volume node as well, which you will see in one of the examples that the market comes down to a low volume node and you get the bounce from it. So watch out for that. They're the key areas that you want to be thinking about. So always have those in mind. Where's the market likely to be attracted to? Where's the market likely to be rejected from? So let's move on. We'll have a look at a few examples. I've got a few more videos just explaining, running through all of these different aspects: closes out of value, movements to high volume nodes, trend type days, single prints. We'll have a look at all of it. So here we go with a few video examples. Let's go and have a look at a few trade setups, and also we'll take in a few other concepts or things that are worth remembering and noting when looking at profiles. So first up, we have got a balance to imbalance type trade and also a move through a small value area. First thing to remember, small value areas are unlikely to hold. So what I mean by this is you're unlikely to see either extreme of value actually provide much support or resistance. You expect the market can cut straight through them. What is also interesting about this day is you've got a very prominent VPOC. Prominent VPOCs generally attract price as well. So we've got a couple of clues already that the market may well start to come off on this day. What we've had prior to this is we've had a move down. We've also then had a consolidation day, which is this profile here on the 19th, starting on this red candle and ending up here. So that's what we've had in the run up to this trade. We've seen consolidation, the market is coming off. Now we get a gap higher, you're going to get one of two things. We've got a small IB. That's telling you that there's a good potential for some type of trend for the day. We're either going to see a move back to top of value, rejection, and move higher. This I would expect to turn into more of a P-shaped day as these shorts on the 18th on the move down get out. Or we're going to see a trend through value. As I said, because there's a lot of volume accumulated, because the value area is small, you will expect trade to move quickly through it. That's what we saw. So where is the trade? It's on momentum. When you start seeing momentum into value, when you start seeing volume picking up as we come into value, that's where you want to be looking at a short. Your stop is going to have to be inside the initial balance, and you're looking for a continuation lower, and ultimately your target is going to be that previous day's low. So you're getting a pretty decent risk reward for your trade. Additional trades to be looking for. As I said, prominent VPOCs attract price back. And what we get is the first move down actually hits the bottom of value. We then get a bounce to the prominent VPOC and also the top of single prints as well. That gives you an opportunity to sell if you've not got on the first move. If you have, it gives you an opportunity to pyramid, and still you're looking for this low. Once again, because you've got this trend type day, you get another attempt at a single print trade. You see the R's come up and make the single prints here at 70s. You then get the Z prints come up. Remember, with these single print trades, the very important thing is you take it the first time. So the Z's come up, you can get in right there. That's the Z prints. Your target, because we are on a trend type day, is going to be a new low. You do eventually get it, and it comes in down here on the break towards 35s. Something else to note as well, and this is more looking at composite volume. After those Z on that first low, and after the Z prints, the push to the low, both come in around this low volume node here. So that's always going to be a key area on these breaks. Look out for those low volume nodes. So that's what you get on the balance to imbalance. Now, what you get the next day is, once again, prominent VPOC attracts price. We've got another gap higher. Prominent VPOC attracts price. We get a test down to it, and the market turns off this VPOC. We get a move back higher, and then we start to fill in these single prints, fill the volume in. But you do, I'll get rid of some of these arrows for you. You do again get a chance to trade off the single prints. Here's the singles, and the A prints, first time they get there, offer you a good sell. You get that sell opportunity, and the market rotates back down on the Bs, back towards that 72 area, this level just down here. So again, single prints do work even the day after. Keep your eyes on them. The prominent VPOCs work as well, so watch out for prominent VPOCs. They will attract the market. Once we got through the close, we get a small squeeze, and then the market turns around again. So watch out for those prominent VPOCs, and as I say, carry forward the information that the close was not or had not yet been tested, so you expect the close to get tested. Next up, caught in the hole trade. This is a great example of a market attempting to do one thing, but doing a very bad job of it. What we've got here is we've got the Bund, and we've got the Bund attempting to fall. First up, we've got this large, strong down day, followed by an inside day here. An attempt lower on this day, which then closes much higher, hence this green candle, and then another attempt lower on this secondary red candle. So looking at that candle, you're very much thinking, yep, we've had a good go getting lower, we've closed low as well, looking like quite a strong day to the downside. However, when you look at the profile, it's telling you something very different. Value has not shifted. If anything, value is slightly higher. The VPOC prominent is still very high on the day. And then the close dropped late on low volume. What does this tell you? The lack of volume into the close means that it is generally weaker participants that have driven the price down late on in the market, and they're closed down there. They now have got themselves caught in the hole, and what they need is continuation the next day. They need to see the market continue to come off. Initially, it does work for them. You get the open down here, so you've already got an open lower, test back up to the close, and then begin to fall. So they are getting what they want. My first trade on a day like this, when you've seen this close very low, is to buy the open with a stop below that day's low. The idea being that you at least get a run back up to the close, and that's what you would have got, giving you pretty decent risk reward on that trade. You get 70s, you get up to 83s, and you've got a risk of around about 5 ticks on that trade. So as a first trade, that's what you're looking for when we close right out of value, caught in the hole. Now, what happens after that is we get this move back up, and we break on the end prints above the initial balance high, above the close and above this low. So now you're thinking, right, anyone who was holding on to those shorts, and people who may well have added as the trade did work, it did push them on side, are now trapped. Any moves, any closes back above this initial balance, and you're looking for a move higher. And so what is the trade? You want to be buying any close above the initial balance. You want to be buying any dips back to the initial balance, and we do get it on the S prints, on the R prints, and on the Q prints. all at the same prices, around 84s, 85s. Your target, because you've got this dip of volume, is back up to the top of the single prints. Single prints and LVNs, low volume nodes, as we know, act as resistance. And so the first time we get up there, excuse me, you do it on the V prints, gives you an opportunity to sell the low of the singles. You also get the Z prints to sell the high as well. And both times you do get a rotation back down the page. So there's your target if you're not, or there's a trade if you're not long, but also that's your target if you are long, based on the fact that traders are caught in the hole, they're gonna have to get out. And you do essentially get another one of these P-shaped days where the shorts are caught and they all start to get out. So that's what you're looking for on a caught in the hole trade. The only way this type of trade is going to turn over into continuation is if value can establish lower quite early on, and then the market can continue lower and continue to trend. I mentioned this trade a couple of times already, the single print continuation trade. Something that I do like to use on a trend day, on a P-shaped day as well, but trend day in particular. Now, this is on the DAX. This is that breakout day that I showed you earlier, but in a little bit more detail. This is on a 15-minute chart. Now, what we get is we do get the very strong move very early on. So you've got the indication of a trend day. You've got this breakout of single prints, breakout of the initial balance, leaving single prints. We also, as you remember, have taken out some clear levels, taken out those 93 highs there. That's what got the break on those single prints. So you're immediately thinking, right, a trend day could well be on. Where can you get in on this trade? So first set of single prints, there's your opportunity. And they come in right here at 22s. That's these lows. That gives you a great opportunity to get in, and often gives you a better opportunity than perhaps trying to play a flag type trade, just because it gives you a more certain entry, whereas a flag, you've got to play it as a breakout trade. A single print for a continuation, you can have it as a resting order. So you can have your bid to buy 22s. It's then a case of where you put your stop. Generally, when I look at a trade like this, I'm either going to have my stop below the fill of the single prints or 10 ticks through them. Depends on what is smaller. You don't want to really be taking this trade on looking at a stop of around about 35 ticks. It's a pretty big loss in the DAX in particular. So that's how I manage that trade. You look for a resting bid, and then you're looking for continuation. The fact this is a trend day tells you that you don't necessarily want to be getting out on the break of the high. If this is looking like a P-shaped day, if you feel there's a lot of shorts that are just getting out, then having bought these 22s, I'd be looking to get out on this spike above the high. Because it isn't, you are looking for a trend. What often happens is after a break of key levels, you then get a grinding trend, which is quite a difficult thing to stay in on, or at least get in on. What you're going to be looking for is you're going to be looking for a flag break, which you do get, and then to try and stay in the trade, but it is slow burning. So just keep that in mind. You can then trail a stop on these single prints, and again, you get another opportunity on the A, B prints, which comes in around these 93 area, just up here. So same type of trade again, and then you can let it go and look for another new high or a little bit of a continuation type trade. As I say, my other target is I scale half on the way to the high of the day at the time. So it would mean you're scaling out somewhere in this area on those first 22s, but what it does is it just banks a bit of money on the trade and allows you to just then perhaps trail a stop, let it go. Once this uptrend establishes as well, you can then start adjusting the trade and perhaps have your trailing stop below the uptrend. So that's how I look at these single print continuations. If it is a trend day establishing, what it means is you don't get caught up trying to buy every little flag, every little attempt at a breakout, particularly once you start getting into the grinding trend phase of the day, which does get a little bit more difficult. So there's your single print continuation, one of my favorite trades.